In our previous segment, we had discussed about the expense method of joint life policy. You know it very well that there are two methods of accounting treatment for joint life policy. One is expense method and the second is asset method. Now we are going to start asset method. In expense method, there was no role of surrender value. But in this asset method, the surrender values of the joint life policy will play very important role. Before I start this asset method, I must remind you the definition of asset. You know, asset is viewed from 3 points. Number one, anything we own that has economic value is our asset, like building, furniture. And number two, if we have paid in advance but the benefit will be received in future, that's also our asset, like prepaid rent, prepaid insurance. And number three, anything that is receivable now or in future, or anything that can be made receivable today is asset. For example, debtors. So let me explain again. Anything that can be made receivable today is our asset. In this category, the surrender values of the joint life policy will fall, because surrender value means if we terminate the agreement today, this money can be received from the insurance company. It means this surrender value can be made receivable today if we terminate the agreement. It means the surrender value of the joint life policy can be shown as an asset in our balance sheet. Let me explain the whole concept through this question. Suppose ABC were three partners sharing profits and losses in the ratio of 1:1:1, and they took a joint life policy for rupees 300,000 on 15th January 2017, and the annual insurance premium was payable at rupees 25,000. These were the surrender values of the joint life policy. 2017 nil, 2018 10,000, 2019 21,000, 2020 33,000, 2021 46,000. These were the surrender values calculated on the day of closings. You know, surrender values are always calculated for the closing dates, not other dates. And this firm closes its books on 31st December each year. C died on 10th of May 2019, and we have to pass the journal entries and make the ledgers as per asset method. So in this situation, every year the amount we pay for insurance premium will be split into two parts. One part will be treated as an expense and other part will be treated as an asset. Suppose 15th January 2017, the money was paid rupees 25,000. It means when we pay the money, the journal entry will be joint life policy account debit to bank 25,000 rupees. Be careful, in this method, I am not going to use joint life policy premium account. In this method, I strongly suggest you to use joint life policy account. So it means on 15th January, in cash book on payment side, it will be shown as 25,000 rupees. And on 31st December 2017, the surrender value is 0. It means we cannot create any asset as on today. It means the money we have paid, the whole of the money will be treated as an expense. It means this 25,000 rupees will go to the debit side of profit and loss account. It will reduce the profit by 25,000 rupees. And the journal entry will be joint life policy account debit to bank 25,000 we have already passed, and as on closing, the journal entry will be profit and loss account debit to joint life policy account. And in the balance sheet as on 31st December 2017, it will be 0 because there is no surrender value of the joint life policy today. It means we couldn't create any asset because the surrender value as per the insurance company is nil. Now let's move to 15th January 2018. How much we paid today? That was 25,000 rupees. So again this 25,000 rupees will be split into two parts. Some part will become expense for the firm and another part will become the asset of the firm. So what will be the journal entry? Joint life policy account debit to bank 25,000 rupees. It means in the cash book 25,000 rupees will be shown as a payment on the credit side. And as on 31st December 2018, what is the surrender value? If you look at the table, the surrender value is rupees 10,000. It means if we wish, we can get rupees 10,000 rupees from the insurance company. It means as on today, our asset is 10,000 rupees because this money can be made receivable today itself. So it means out of 25,000, we could create only 10,000 rupees as an asset and the remaining part of 15,000 will be treated as an expense. So what will be the journal entry? As on 31st December, profit and loss account debit to joint life policy account rupees 15,000. It means on 31st December in profit and loss account on debit side to joint life policy 15,000 rupees will be shown and in the balance sheet it will be shown as joint life policy 10,000 on asset side because this will be shown as an asset. That's why this method is called asset method because the surrender values of the joint life policy are shown as an asset in the balance sheet. Then again on 15th January 2019, again it's due date and we have to pay insurance premium and the journal entry will be joint life policy account debit to bank 25,000 rupees. But before we reach the closing of 19 on 10th of May 2019, she died. So you know the moment the partner dies, the whole of the money, I mean to say the policy amount becomes receivable from the insurance company. So what will be the journal entry? Insurance company account debit to joint life policy rupees 300,000 and immediately this income is transferred to ABC. So journal entry will be joint life policy account debit to A's capital to B's capital to C's capital. But the whole of the 300,000 will not be transferred to ABC. We will need a ledger that is joint life policy account. So let's prepare joint life policy account. If you look at the journal entries on 15th January to bank 25,000 rupees and on credit side 31st December 2017 by profit and loss account and by balance CD. Let me remind you, there are three types of accounts: nominal accounts, real accounts, personal accounts. All nominal accounts go to profit and loss account and they don't go to the balance sheet. But all personal accounts and real accounts, their closing balances, they move to balance sheet. So it means balance sheet is a collection of the closing balances of personal and real accounts. Here the joint life policy account is a real account. This is an asset account. So today the CD means the closing balance will be 0 because there was no surrender value of the joint life policy as on 31st December 2017. So by profit and loss account will be 25,000 rupees and the total on both sides 25,000 rupees. I have already told you on 31st December 2017 there will be nothing in the balance sheet because as on today the surrender value of the policy is 0. So we cannot create any asset. So that's why the CD or you can say closing balance is 0 and this closing balance becomes opening balance in the beginning on the first day of next year. So it means on debit side 1st January 2018 to balance BD nil. Then 15th January we have paid 25,000 rupees. So to bank account 25,000 rupees. Now come on credit side. On 31st December 2018, by profit and loss account and by balance CD. And today the CD will be written 10,000 rupees. And by profit and loss account, this is the balancing figure, and that will be 15,000. Total 25,000 rupees. So you can see on 31st December 2018, the closing balance is 10,000. This closing balance will go to the balance sheet asset side as rupees 10,000. This is the surrender value of the joint life policy. This will be shown as an asset in the balance sheet because surrender value is the asset for the firm. And in the same way, next year on 1st January 2019, this account will be reopened to balance BD 10,000 because the closing balance of last year becomes opening balance for the next year. And on 15th January, we have to pay the premium. So to bank 25,000. But before we reach the closing, on 10th of May, C died. So this account will be closed on the day of death. And the journal entry was insurance company account debit to joint life policy. Means joint life policy account was credited. So come on credit side on 10th of May 2019 by insurance company 300,000. So on debit side on 10th of May 2019 the balancing figure was 265,000. This balance will be transferred to A, B, C. So 2A is capital, 2B is capital, 2C is capital. You can write down in the inner column 88,333, 88,333, 88,334. You know, we couldn't write down this amount in the journal entry. Now we can complete the journal entries. That will be joint life policy to ABC. 265,000, 88,333, 88,333, 88,334. In this way, the asset method is tackled. So whenever there is asset method, it means all the surrender values of the joint life policy will be shown as an asset in the balance sheet. And every year, the amount paid to the insurance company will be split into two parts. One part will be treated as an expense and the another part will be treated as an asset.